We're going to be joined now by our CPA expert, Suzanne Conrad. Suzanne, thanks for joining us on our program.
Hello, thanks for having me back.
And Suzanne, what is your role with Allworth?
I am the director of tax solutions, so one below the vice president. I kind of manage the Folsom team, work with all of our CPAs, enrolled agents, make sure our training's on track, make sure we put out a quality product, and prepare and review returns.
How many?
Provide a lot of planning.
Scott and I are no longer the acting CEOs of the company, so I ask this in all seriousness: how many enrolled agents? How many people work in that division of the company?
Well, I could have told you there's 9 of us here in Folsom, but we've gained some people, so I don't know the total number. I think it's around 30.
Okay. So, and the job is to support our financial advisors
with tax guidance, tax planning, and sometimes tax preparation
for our clients. That's the role, correct?
Absolutely. To provide integrated financial advice, right? So we work with the advisors, we work with the clients, and make sure we're optimizing their financial future, including the tax piece.
Because if you listen, this is for the listener, Suzanne, you know this. If you listen to our show, we talk about how important tax and estate planning is.
Massive.
In the financial planning process. That's why it's integrated into the firm itself.
I don't know, frankly, and mostly big Wall Street firms, they state we cannot provide tax advice. How can you give good financial advice and ignore tax advice?
And actually, and one of the benefits of actually becoming a larger firm and integrating these other firms is that you can get to scale and have divisions like tax solutions, insurance solutions, and estate planning. So,
yeah, so
enough of our commercial.
Suzanne, what are some of the most overlooked tax saving strategies that individuals and families that maybe the employer they overlook? Maybe focus on those that with $1 million or more in savings.
Boy, that's a loaded question. My intermediate accounting teacher's favorite answer was, it depends. And that definitely applies to this question. You know, what are their circumstances? Are they at or near retirement? Are they a young family starting out with college costs to consider? Is the money in IRAs, mostly qualified accounts, or is it after-tax investment accounts? Are they high earners? You know, are they retired in a low bracket before Social Security and RMDs kick in? It really is specific to the client situation. But having said that, the most obvious and frequent tax savings I see overlooked is clients not optimizing their retirement plan contributions, like not maxing out their 401k or, you know, whatever their employers offer. If they have an employer, you know, if they're earning income, people aren't maxing that out. And that's just such low-hanging fruit, right? I mean, you got to at least do that minimum if you're optimizing your tax situation.
And
for me, when I see it, it pains me.
Especially if there's a match.
Especially if there's a match.
Well, of course.
You can do it pre-tax, or you can do Roth. A lot of employers have Roth contribution options, so you know you can split it depending on your situation. But you know you might as well at least do that if you have the cash flow for it.
And are there any specific deductions or credits that individuals or families with more than $1 million in net worth tend to miss?
Yeah, you know, a lot of the ones I see missed most often is the QCDs, right? It just
the what?
The QCDs, qualified charitable distributions, coming out of IRAs. So you can do that when you hit 70 and a half. And a lot of clients will make donations thinking they're going to get a charitable deduction, but they don't itemize because the standard deduction is so high.
Yes.
So, you know, for anybody 70 and a half, if they're charitably inclined, they really ought to do that.
And how often have you seen this missed?
Often.
I mean, you know what you think of, and because it can work for $500 or $1,000 or $1,500. It even.
And this
small
is anyone
amount.
who's 70 and above, 70 and a half and above. They can gift up to their qualified, their required minimum distribution. Although technically there's not there for 70 anymore, but the requirement that up to the required minimum distribution to a nonprofit. And it doesn't go through the tax return at all, right? It just goes automatically there. They don't have to report it as income, and nor do
Correct.
they.
It's actually $108,000 a year per person, so they can do quite a bit and not have that IRA withdrawal.
And is that the maximum, or is that
It's the max?
But if someone has 200 grand in their 401k, can they give 108 grand, or is it the maximum whatever's greater, the 108,000. I'm sorry, the
It's
lesser of.
108. It's got to be from an IRA. I don't believe those
Understand,
can come from-
but it can be above the required minimum distribution amount.
Correct. Yes.
Oh.
I didn't know that.
But it cannot go to a donor advised fund.
I know that, but I didn't. I knew that maximum was 108, but I didn't know it could exceed the RMD, and
Yeah.
mostly because there's clients typically don't exceed their RMD with these qualified charitable distributions. So
Right.
this is something that is kind of like a no-brainer. Why do they not allow it to go to a donor advised fund? It would be used
Because
so
a lot
much
of
more.
people don't spend the money. They put the money in the donor advised fund and they never give it away. There probably should be more. That would be an area of legislation I would think would be helpful to.
I actually know someone like that.
You do?
Yeah.
Yes, we put it in there and don't give it away as fast as we should. Okay, next question, Scott.
What other deductions or credits do people tend to miss?
You know, a biggie right now is the electric vehicles. People buy them and think they get the credit, and for one reason or another, they don't. So you have to be really careful. That they have a lot of requirements now. There's an income limitation. So if you're over 300,000 married filing jointly and you try to take that credit, it's going to get disallowed. We actually have a client whose prior accountant took it and it didn't meet the manufacturing requirements. They owed $7,500. It's a 25% penalty on the understatement of tax. So they're going to owe like 10 grand thinking they qualified for this electric vehicle that they don't. So, you have to be careful. If you're buying an EV to get the credit, just make sure, you qualify for it and you do your research.
Talk to the accountant beforehand.
So Suzanne, this is a little bit off topic, but I just find it fascinating about the new tools that we're using at Allworth. I saw a story this week that someone had missed a charitable deduction and it was going to expire, but how we are able to take past year tax returns and run it through an AI system, right? Pretty easily, that flags problems that previous accountants have made. Can you talk a little bit about how this thing works?
Yeah, it's a pretty sweet program. It takes the prior year return and it just offers some guidelines, some planning guidelines, like for IRMA brackets, for Medicare, you have this much room in your next tax bracket. So look at a Roth IRA conversion. It's really nice for pretty straightforward planning. If you have a lot of rentals and Schedule C income, it's a little less efficient for that, and you need to use some real tax planning software, but it's a really handy tool. I really like what it pulls in the prior year return information and prints out a report that's really easy to read and understand. And so it's really a great thing that the advisors get to use now.
And how far back will you go looking at people's returns?
Well, the statute is 3 years.
Will you go back? Will you go back 3 years and ask for the last 3 year tax returns to look to see if the previous prepared or the client themselves who are doing their own taxes had done it correctly?
Usually only if we see something. So we'll look at prior year, and if there's something suspect, then we'll go back farther. Or if, the client comes to us and says, I didn't really trust my prior preparer, then we'll go look. But it's usually just, the prior year, unless we see something where we need to look further.
And what percentage of times do you actually find problems with prior year returns?
That's a good question.
I'm
self-prepared returns, probably 50% or more.
Okay.
Are you kidding me?
Self-prepared.
No.
I heard that. So I'm just thinking the sample of client you work with, right? So you're not, and I'm not going to mention a name, but you're not dealing with like these are Allworth clients.
So they have
savings.
Yes,
right?
money.
Right. And these are people that have saved well. They're Allworth clients, wealth management clients, and been doing the taxes themselves. And you saying that more than half the time they're making mistakes.
It's often, yeah, especially if they have like a rental or something, because usually they come to us when something changed, they can't do it themselves or they don't want to, or, their partner who was doing taxes no longer can or something like that. So, yeah, it's pretty high with the self-prepared, unfortunately.
And how
think of QBI getting this, stuff like that.
And how about from someone that has had it professionally prepared? What percentage of the time, just ballpark, do you think that you find mistakes?
We actually just quizzed all our preparers, and I'd say it's probably 20 to 30% of the time.
from someone else brings in a tax return for another preparer. How do we guard against that?
Say, what percentage of Allworth tax returns are inaccurate?
None. No. We do have a pretty good quality control process that's higher level. And I was going to just say that, tax season is crazy and the pace is insane. And so things do get missed, but we do have a pretty strict review process and quality control that we go through. So, I personally loathe amended returns. I never want to have to prepare another one. So my goal is to not miss anything.
And are people reluctant to file extensions?
Very much so. Yeah.
And can you talk about why someone should file an extension? I never understand why people are reluctant to file an extension. Can you explain what a tax extension actually means? When do you write the check and when the tax return actually gets done? Can you just walk us through that?
Yes. Well, my husband has an S Corp, and I finally broke him and told him that no preparer files on time. So he was one of those people that hated to extend, but
that's hilarious.
As long as your planning is good, you don't have, what your estimated tax is going to be. The extension just buys you it's an extension of the time to file, not an extension of the time to pay. So, if you file an extension in April, you get until October to finish up your tax return, but you have to pay and, what you think your tax liability is going to be in April, or you get subject to penalties and interest. And I think that's a lot of it. People don't understand tax. If they did, they probably wouldn't be having us do it. So it's involving their money. It's involving security. It's, the IRS, and that's scary, right? They don't want to get a notice. And so there's a lot of emotional stuff that comes into it, but really, if you're doing good planning, it's just really not a big deal.
So
and sometimes it's just impossible to be. I mean, if you have a very simple tax return, it's easy to get it done by April 15th. You talk about your husband's got an S Corp. Well, that means you got to do the business's taxes first. And then if you've got other investments with a partnership, sometimes you don't get a K-1 until October.
But here's the point to the listeners, right? Is you estimate, you do a quick and dirty, this is how much I think I'm going to pay on my taxes. And then you pay that amount and sometimes a little bit more.
Yeah, a tax April 15th.
You pay by April 15th. And then when your accountant isn't working 18 hours a day,
that's right,
you go back to them in June and you say, let's do our taxes now, or July or August, when they're not buried, and you do your taxes, and then you file the real return as late as October 15th. And what's that?
And then we can give them time, right? We can sit with them and walk them through every question, and it's a better result.
And you actually get better tax planning, not just preparation in that. Which is what the advisors do. So our advisors work hand in hand with the accountants for more complicated financial situations to make sure that not only is the preparation, by the time it's done, it comes as no surprise what's happening, right? It's the tax planning by the way,
that planning's not happening in March and April.
That's right.
Because our entire tax team is buried doing tax returns.
That's right. So anyway, how is it going this tax season? You buried yet?
You know what? It feels like tax season today, but it's pretty good. It's not bad. We've got some good staff, and we're getting our systems down, and we've had our clients for a long time, so it's all good. There were no major tax law changes, so that's always a bonus, right?
That's right.
The whole country wasn't impacted by disasters. Southern California was, but it's been kind of a normal year, so it's going pretty well.
Good. Perfect. Well, thanks, Suzanne. Appreciate it.
Thanks for being part of the team.